I do invest in international index funds, right? So one in particular that I invest in is the Vanguard Total International Stock Index Fund. And this is for some diversification, right, among different countries when it comes to stocks. I also have the Vanguard Emerging Markets Index Fund. I invest in, companies that are not from the U.S., one of which being Alibaba, right, which is a Chinese company. I'm not going to give you guys all my holdings, but that's one in particular that I own shares of, right? But if you just look at some of these international indexes and compare them to U.S. indexes and say, well, how have they shaped up? How have they compared to the United States? Because if the United States is so much better, if you should never bet against it, then shouldn't the United States companies be blowing these international indexes out of the water? Well, yes, and they have, right? So I'm just looking over the last 5 years, and the reason that I'm doing this is because the two funds that I'm looking at, one has existed a lot longer than the other, and so we can't get the max return difference here, but I'm just looking at a 5-year period. Now, from 2016 to today, right, from 2016 to 2021, you look at the Vanguard 500 Index Fund versus the Vanguard Total International Stock Market Index, right? The Vanguard 500 has made 100.08% in a 5-year period, meaning if you would have invested your money 5 years ago, you would have doubled your money in the Vanguard 500 index, which is a great deal. That means on average, you've been looking at an annual rate of return that's been somewhere around 14% per year, which is just fantastic, right? Then with the Vanguard Total International Stock Index Fund, you have seen over that same 5-year period a 44.9% rate of return. And this is like, oh, wow, that's, a 55, 56% difference. Then why would you ever invest any money in these international funds? Well, very typically, if the United States is struggling, then so are other markets, right? We see a lot of global parallels in markets nowadays, right? But it still doesn't mean that, if you invest in some of these international funds and the United States has something specific to it that goes wrong, that you can't be hedged a bit against the United States and maybe still get some growth, even though you have investments in other places. And my investment in international funds is not extremely high, and it's nowhere near what I have in things like the S&P 500, but it is still there, and it is still a particular hedge that I do use. Now, so you see that big difference in returns over time. The U.S. has done extremely well. Now you say, okay, well, that's only 5 years, right? Well, with those two particular funds, if you back out to when the Vanguard International Stock Index Fund was created, right, it was created back in 2010. You go from the day that it was created, so it had a 0% return. The day it was created, the Vanguard 500 Index Fund, since it was created in the early 2000s, right, it had actually a negative return to that point, to the day that the international fund was created. It had a negative 13.12% return. So the other fund actually gets a head start. The international fund actually gets a head start. And if you look from back in 2010, so 11 years ago to now, right, the Vanguard 500 Index Fund amassed a return that was 207.6% positive, and that goes its entire life, right? But it went from negative 13 up to positive 207.6. And that Vanguard Total International Fund only returned 36.64% over that 11-year period. So an even greater disparity at this point if you look at the entire life of the international fund. And that doesn't mean that it's necessarily a bad international fund. That just means a diversified group of U.S. large cap equities has vastly outperformed a diversified index of international companies over time. Now, of course, there are international companies that have grown many-fold and have done very well at growth and innovation. That is not to be argued, right? But we're talking about diversified groups of companies that you can take and invest your money into and just allow your money to grow. The S&P 500 has just been hard to beat over a long period of time. So you even want to go further with the S&P 500 and say, okay, well then what's the return been over a longer period of time? If I want to know what kind of returns I can expect, then let's take a look. Well, from May of 1921 to May of 2021, a 100-year period, right? The return on the S&P 500 with dividends reinvested. And if you remember, dividends being reinvested means that the dividends that you get paid just get invested back into whatever you are invested in. So back into the S&P 500 here, right? Would have provided an annualized S&P 500 return of 10.732%. So if you would have started investing 100 years ago, right? And invested just systematically from then on all the way until today, then your money would have made 10.732% annually over that time period, which is a fantastic rate of return and is a rate of return that on average will double your money about every 7 years, which is fantastic. Now, some people think in this day and age of cryptocurrency and high-flying growth stocks that that those are, pedestrian returns and that people are boomers when they're trying to go and get 10% returns. But over the long term, right? We're not talking about short term. Over the long term, getting 10+% a year returns is fantastic. It's what you want. You want to shoot for that 10% number. That 10% number is fantastic, and it's very, very hard to beat. It's very, very hard to beat the S&P 500 over a long period of time and continue to multiply your money in the way that it has.